Welcome to the InterMarket analysis video update. This is the video that I do once a week where we look outside of the S&P 500 to see if we can get some clues by looking at other markets as to what will happen with the S&P 500 itself. This is being prepared for Monday, April 7th. So the areas that we'll cover, first I'll go through valuation on a historical basis and then forward looking. We'll look at growth versus value. That's really been a focal point of late. We'll look at inflation. There's a lot of inflation fears are out there. Do we have concern about inflation, or is there possible deflation coming into the picture? We'll look at some other markets outside of the S&P 500 as well as completely different markets. We'll look at the sectors, the 11 sectors that make up the S&P 500 and then compare them to the S&P. We'll look at some other indexes, not only within the stock market, but over in the bond market as well. We'll look at correlations between different markets to see if we can get any insight there. And then we'll look at some long-term trends just to see how are things shaping up for right now. At the very end, I go through a positive list and a negative list. And even though this was a pretty significant down week, we really haven't seen any changes, at least yet, with our positive and negative list. All right, first we look at valuation. This looks back at historical earnings and compares them with price. And we use a 10, 15, 20 scale, and we call this the PE ratio, the price to earnings ratio. When we're at 10 or below, that index or market is considered to be inexpensive or cheap. When we're right around 15, which really means between 11 and 19, then we're fairly priced. And when we're at 20 or above, the market is considered to be expensive or overvalued. Looking at a historical basis, we have been really coming down with the S&P, but we're still well above this red dashed line where the PE ratio of 20 should reside. If we keep falling and get back down to a more manageable price to earnings ratio, we should go all the way down to 4,000, where we're just starting to drop below 5 or getting near the low end of 5,000 right now. To break this out, I have the difference between the current price of the S&P and the red dashed line. I don't use this to make decisions. We just use this as an informational tool to know, okay, is the market expensive, inexpensive, or fairly priced? Also, those same figures are added to this chart given some different events that have happened and what the valuations were at that time. Now, a variation of the PE ratio, which is just more of a raw value, and looks at earnings as they're released, Robert Shiller developed the Shiller PE ratio, where it takes a smooth approach over a 10-year period of time to try to get rid of any outliers, either positive or negative. Now, this has been coming down. We're getting a reading of 31.31, but compared to the median and mean between 16 and 17, even after the declines that we've seen on a historical basis, the S&P is still expensive. But the market looks forward, and we're seeing a real coming down of forward-looking PE ratios. The purple line here, this is the mega cap 8. Some people classify this as the magnificent 7, the illustrious 11, whatever number you want to throw in there. This purple line is really coming down. It's still above 20, so it's still expensive, but we had spent a lot of the last couple of years being up into the high 20s. Well, as the market's been under pressure and in a downtrend lately, these stocks, the mega cap 8, they get sold the first and they go down the fastest. And that's why we're seeing this really dropping off. We're actually coming down now below 20 with the forward-looking PE ratio for the S&P. We were getting up above 20 and getting close up to this 22 level. That's when we're really expensive. Well, we're dropping down below 20 right now, coming in at 18.2. So that's getting to be more fairly priced with earnings going off into the future. And then the mid caps and small caps, they've been getting hit hard. They were right around the 14 to 15 level for quite a while. They're really dropping off, coming in at 13.2 with the mid caps and 12.9 with the small caps. Then this breaks it down into the 11 different sectors, coming in right at about 20 at the time this chart was prepared. The more expensive areas would be industrial, staples, that's a defensive area, tech, growth, and discretionary, another growth area. This is still the most expensive part of the market, even though it's been getting hit hard lately. then anything under 20 is more fairly priced. The cheapest area of the market right now is energy, coming in at 14, and financials at 16. So they're right around that 15 level. Communications really been coming down as well, coming in at 17. Now, some folks might use something like this and go, oh, energy's looking cheap. Maybe I'll buy that. Or communication, that's a growth area. Maybe I'll get into that now that it's considered to be cheaper on a PE ratio basis. Then we look at growth versus value. Here is the growth chart just getting hammered, down 6.5% just on Friday's session alone, and really declining below its 200-day moving average. But value got hit too. It crashed 5.5% in Friday's session, falling below its 200-day moving average. Where we get the insight is when we look at ratios between the two. In a more positive, offensively driven market, that's when we see growth really going up. When growth starts to come down, that means the market could be getting more defensive. So I have a growth to value ratio on top showing some weakness and a value to growth ratio on the bottom showing some strength. And that's been a concern to us. And that's what the market has been starting to do more of lately. We look at another growth to value ratio coming down, dropping below the 200-day moving average with this ratio, looking at these ETFs. This is a value to growth ratio showing both that value's been really doing well lately. Then we look at another growth to value ratio here, really coming down, getting close to a death cross with this ratio. Then this shows how growth has been outperforming or value's been underperforming, but lately really starting to bounce back as there's been concern about the tariffs and what's going to happen to the economy. And is the market really getting geared to go down even more? What we're seeing now is similar to what we saw at the end of 2021 going into 2022. And this shows growth is still outperforming, but really falling back lately. Then we look at a growth versus value ETF, showing how growth has really been underperforming. This shows how value's been outperforming when we do an inverse of that same chart that we saw earlier. We're not really improving here with our small cap growth to value ratio, still under the 200-day moving average with this ratio, also declining below the 200-day moving average with mid cap growth to value, and declining even more with S&P growth to value. And this is what we focus on the most, and weakness in this area is not giving us a lot of confidence. We want this ratio to go back up. We want it to get above these lines. We want to avoid this death cross that may be happening fairly soon. If this continues to fall, that likely means the S&P is continuing to decline itself. All right. Then we look at a monthly chart of the CRB index, which it really came down. It had been stronger, but it got hit hard last week with everything else. So we're not really seeing a longer-term inflation concern at this point, other than this red moving average has been slightly going up, but it's not really going up with much velocity. What we're seeing a little bit more of is more deflation. That means that inflation is going down compared to deflation. And if this continues to fall, that might be more of a concern that we want to be aware of. That could suggest more of a recession type of situation rather than an inflationary type of situation. And we look at the CRB index, which is still in an uptrend, but it came all the way back down to its 200-day moving average. It got hit hard too. It was down 5% just in Friday's session. And saw a little bit of a drop here, but we've been coming back up with the Baltic Dry Index. This is another inflation gauge. It's really not giving us a lot of concern right now. It had been going back up, but this is for shipping products throughout the Baltics. As a general rule, if this is going up, that's more inflationary. If this is going down, that's more deflationary. And then what about the inflation expectations? This is a weekly chart showing that since the beginning of 2025, the market's actually expecting inflation to go down. Some of the other markets, we're in a downtrend with aluminum. That's not inflationary. Corn is still in an uptrend, but pulling back. Wheat is still in a downtrend. Fertilizer falling down after it had been coming up just a little bit lately. That's not inflationary necessarily. Lumber was in a pretty solid uptrend. That could be considered inflationary, but it fell back below its 50-day moving average. It was down over 2% in Friday's session. Oil's really dropping down. We're getting into the low 60s now. That's not inflationary. We look at the gold to oil ratio. Gold's been doing well. Oil's been dropping, so we're seeing this ratio going up. Then we look at the correlation between the 10-year yield and oil. We see that there's a pretty strong correlation right now. They're both going down. Gas also starting to get into an uptrend here, but it's been really choppy lately. Heating oil is in a downtrend. Natural gas is in an uptrend. And diesel, it's spiked up a little bit, then it's been coming back down, but it's still confined within a pretty tight range lately. So that's not necessarily considered inflationary. And copper, which is a barometer of the economy, this is a daily chart. And we came all the way down to the 200-day moving average. Now, this has been pretty solid, and we were setting recent highs with this chart. This is suggesting, according to the copper market anyway, that things look pretty good economically going forward. Now, if this continues to fall and we roll over and we start to see downtrends instead of uptrends, then we'll change our view on that. But for the time being, we have been going up pretty much since the beginning of 2025. And the copper to gold ratio is really going down because copper declined and gold went up. So we're seeing this ratio falling off. A longer term look at this chart, also plotted here with the 10-year yield and the 2-year yield, just to give it a little bit more context. Gold was down in Thursday and Friday session with everything else coming off of a recent all-time high. Silver really down here, fell below its 50-day moving average on Thursday and its 200-day moving average on Friday. Keeping an eye on the closing price of gold, which has now been dropping, but silver's been dropping even more. They're pretty much neutral, which is strange. Usually this correlation is pretty strong, meaning that gold and silver tend to move in the same direction at the same time. Then we look at a gold to silver ratio on top, and gold really outperforms, so that really spiked. Then we can compare this to the US dollar index down below. We're getting kind of a neutral to slightly opposite move reading right now, which usually we don't see that. Usually there's a pretty strong correlation between the two. This is showing a weakening correlation as there's been a lot of upheaval throughout the precious metals markets as well as the currencies, specifically the US dollar. And the dollar is down under its 200-day moving average. We stay down below this, we could turn into a downtrend. And we look at the euro, which has been bouncing up on top here compared to the dollar, which has been going down. And then we look at the Japanese yen, which is also now in an uptrend compared to the dollar. So here's the euro. It's still in a downtrend, but really starting to outperform here. We stay above both of these lines. This could actually turn into an uptrend, meaning that on a trending basis, the euro is outperforming the dollar. The Japanese yen is already in an uptrend compared to the dollar. And the British pound, not quite there yet, but it's been really doing well compared to the dollar as well. Then we look at some index ratios. Everything just fell off a cliff in Thursday and Friday session. We're seeing both the S&P weighted version and the equal weighted version under a lot of pressure right now. We look at the ratio, not much of a change here. When this is going down, that means the equal weight is underperforming. To say that another way, that means the big growth stocks are outperforming, and we've been pretty choppy. This had been going up, meaning that the equal weight index was outperforming, but we're not really breaking out into any new territory yet with this ratio. Then we look at stocks to commodities, and stocks are actually in a downtrend compared to commodities. This is an inverse showing how commodities are in an uptrend compared to stocks. We look at the NASDAQ 100, which has been weak, and the S&P 500, which has also been weak. When this ratio is going down, that means the NASDAQ 100, which is growth, is underperforming the S&P, which is both growth and value. The S&P 100, the biggest stocks that make up the S&P 500, are underperforming the S&P 500. The NASDAQ is underperforming the S&P. Again, most of the NASDAQ stocks are growth, where the S&P 500 is growth and value. The NASDAQ 100, though, has been holding up better than the broader NASDAQ itself. Now, they're both not doing very well. The NASDAQ's incorrect and actually in bear market territory, and the NASDAQ's been really weak, but the NASDAQ's been holding up better than the broader NASDAQ composite. Then we look at the mega cap growth, which really shows an underperformance compared to the equal weight index. This just means we're seeing that rotation from growth to value. We look at small caps, which are just not doing very well. They're even doing worse when you compare them to the S&P, which the S&P has been doing bad too. The red line is the ratio between small caps and the S&P. The blue line is the S&P itself. Mega cap growth, really seeing some weakness here, falling underneath its 200-day moving average. And we haven't seen that now for the last couple of years. Robotics and AI, a lot of weakness here. And we're seeing weakness in the tech sector and in the robotics and AI ETF. So we're not seeing much of a change here with this ratio. Then this is another AI and tech ETF, seeing some weakness here, still in an uptrend, but really falling down lately. And the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, we're below both lines and we really declined. We could be getting ready to see a death cross. We saw a golden cross here in late 2023. And we look at some other stocks. This is traditional Dow theory, showing how the Dow really has fallen. The transports have fallen. The utilities have fallen, but they're more within their range, where the Dow's breaking out and the transports are breaking out to more recent new lows. We're seeing more weakness with the advanced decline line studies. The S&P had been holding up for the most part above the moving average. In Friday's session, we saw more drastic selling and we dropped below the moving average, where we are below the moving average with the NYSE common stock, mid caps, and small caps. The Wilshire 5000, a broad market measure, continues to fall further below its 200-day moving average. Also, the total U.S. stock ETF, another broad market measure, is falling below its 200-day moving average. The low volatility stocks, even they got hit, but they just came down to their 200-day moving average. They're still above that. And then we look at a ratio. Low volatility has been really outperforming the S&P itself. This is the market becoming more defensive. Is this going to continue to go up, or have we topped out and are going to start to pull back? That's what we'll be watching. If it goes up, that's going to be more negative for the S&P. If this comes down, that could be more positive for the S&P. We look at a ratio between the Dow and the transports. The Dow is just really outperforming, even though the Dow's been getting hit too. It's one of the better looking indexes currently because it's considered to be the best of the best stocks. And we're looking at the ratio continuing to go down, even though the S&P has been going down. Transports have been going down even more. It did bounce up a little bit in Friday's session, but longer term, this continues to decline. The transports coming down, falling out of this recent range that we've been in over the last few years. That's more negative. The correlation between the S&P and the transports is still pretty strong here. They both have been going down. And then we look at a new idea behind Dow theory. Instead of the Dow, we use the S&P. That's going down. And instead of using the transports, we use the NASDAQ. That's been going down. This red line here was the previous all-time high. And then we look at a further breakdown of the equal weight version of the S&P, which is breaking down, getting back to its previous all-time high here. And back in February, this did not set an all-time high, where the S&P did. And we're also seeing some weakness here with the equal weight version of the QQQs. The FANG index, the really big stocks, continue to show weakness. ARC underneath its 200-day moving average, and it was down just 7% on Friday. All world, the stocks in the rest of the world have actually been holding up better, but even they got hit on Friday. And then we do a ratio between the two where we're starting to see a downtrend here. This means that world stocks are outperforming US stocks if this ratio continues to be in a downtrend. Then we look at a long-term chart here of another global index with Europe, Australia, and Asia, as well as the Far East. Those stocks being compared to the S&P 500. We are declining here, but we're still above this long-term moving average. But the momentum is really dropping off, and that's more negative. And we look at bonds versus stocks, where bonds have been going up. That's seen as a flight to safety. Folks are getting out of stocks and getting into bonds, and that pushes prices up, which pushes yields down. And so we've been declining with the different yields across all the different maturities. This is a weekly chart. We were watching this red line here. That's the 10-year yield in Japan, but it's really falling back now. And we're seeing a real decline of international rates in the US, the UK, Germany, and then also Japan. But the total bond ETF, this is one of the better performing areas of the market right now, only in second place to gold. And this is in an uptrend. This is bonds based on price. The Pring World Bond Index is still in a downtrend, but it's been really bouncing back up. If this keeps going up, we could see a golden cross. And we're seeing a deterioration on the longer-term monthly chart of the stock-to-bond ratio. We look at stocks and compare them with 1 to 3 year bonds. And you're going to see a lot of this in the next few charts, really showing some weakness here. Stocks are underperforming bonds in the short term. In the broader market, stocks are underperforming 1 to 3 year bonds. A broad market measure with 3 to 7 year bonds also shows stocks underperforming. The tech sector is underperforming 3 to 7 year bonds. And we're going up with this ratio, meaning the bonds are starting to outperform stocks longer term. And we look at junk bonds, high yield corporate bonds. This tends to go more hand in hand with the stock market. It's coming down to its 200-day moving average. These are more conservative bonds, corporate bonds, and they're actually in an uptrend and doing quite well on a relative basis. Junk bonds falling below their 200-day moving average. And we're seeing more of a decline here with the junk bond to more conservative government bond ratio. That just means the market's getting more defensive. And we look at a risk on versus risk off, or riskier bonds versus more conservative bonds. Risk on, risk off was not correct, but we're really seeing a deterioration here as the riskier bonds are not holding up as well as the more conservative bonds. And we look at a stock to bond correlation. They're having a tendency to go in opposite directions. If one's going up, the other one's going down. Corporate bonds still looking okay. They came really close to setting a downtrend here, but they've been bouncing back up lately and looking like a little stronger uptrend is developing. And then we look at some Fibonacci lines here, but we're far away from these lines, so we're not getting any insight. But this is part of the weekly charts that I show. And then we look at the long-term 10-year Treasury yield, showing how we've been establishing a higher range over the last few years for interest rates. This is another fib retracement study I included as part of the video, but we're not getting any insight from this chart. And this is showing how stocks are underperforming the 10-year yield. Then we look at another 3 to 7 year bonds to stocks. Bonds have been really starting to outperform. We could be getting ready to see a golden cross with this ratio. That would still be more defensive. And then we look at the volatility of bonds as measured by the MOVE index. That's been going up. The VIX has been really going up. And we're seeing that there's a pretty high correlation between the two when we look at the correlation at the bottom. Then a monthly chart of the 30-year bond. It's been starting to go back up, and the moving average is starting to level out. And then we do a ratio between the long-term bond and commodities. It's still coming down to its moving average. So the bond price has been outperforming, even though bonds were under pressure. That might begin to change if we see commodities continue to pick up. But they got hit with everything else this past week. Then different sectors. We look at the material sectors, which is it's in a downtrend by itself. And even though it's bouncing back up a little bit, it's still underperforming the S&P longer term. Communication, this is a growth area, falling below its 200-day moving average, but still holding up better when compared to the S&P. Energy, which is just chopping above and below all these moving averages right now. It doesn't really know what to do. And it had been starting to outperform the S&P, but it got hit this past week as well. And so this ratio is coming down. Financials, one of the areas that had been stronger, it also got hit, but it's holding up a little bit better when we compare it to the S&P. Industrials, still in an uptrend, but falling below its 200-day moving average, and pretty much sideways now, but in an uptrend when we compare it to the S&P. Tech, this is the big growth area. We're seeing a death cross here when we just look at the tech sector, and it's even underperforming the S&P. It had been going sideways as both have been under pressure going back to 2024 into the late fall and into the winter. Now tech is even going worse, going down quicker than the S&P 500. Staples, a defensive area, it even got hit this past week, but it's continuing to outperform the S&P 500. We could be getting ready to see a golden cross here. That would be more negative for the S&P. Real estate falling with everything else this past week, but showing some improvement when compared to the S&P 500. Utilities have been going pretty much sideways, but outperforming because they've been going sideways as the S&P has been going down. Then we look at an S&P to utilities ratio, and this is going down. That's negative for the S&P. To be more positive, we want this ratio to be going up. Then we look at healthcare, another defensive area, just kind of chopping all around above and below these moving averages. But it's been starting to outperform. It's another defensive area. and it's been doing better lately than the S&P 500. Discretionary, Amazon, the thing that makes life fun, Tesla, this area's just been getting hit really hard. And even though the S&P's been getting hit hard, the discretionary is trying to make a little bit of a bounce here, but and it's still in an uptrend compared to the S&P, but it's been quite weak lately. Then the semiconductors, a huge part of tech in a downtrend. And there's other ETFs and other indexes I could show. We would be seeing the same thing, downtrend. The energy to tech sector ratio, when this is going down, that means energy is underperforming. Now it's starting to outperform, and we're seeing a golden cross with the ratio. Growth stocks versus more conservative bonds. Growth stocks have been really underperforming as government bonds have been holding up better and actually going up. And then the tech sector to the 10-year yield shows that the tech sector is underperforming. This shows that the 10-year yield is outperforming the tech sector. Discretionary to staples, we want this to be going up in a positive environment. It's been coming down. And then staples have been rising when compared to discretionary. Gold has been going up as the S&P has been going down, so we're seeing this ratio really going higher. And the dollar's been under pressure. Gold's been going up, so we're seeing this ratio going up as well. High leverage loans. This is another barometer of the economy. It spent most of the last few years above its 50-day moving average. It's getting hit now too and dropping below its 200-day moving average. We'll want to keep an eye on this to see, is it going to be able to bounce back up? Or if we see more weakness here, that's going to be quite negative for the market. The NYSE composite was going sideways as the rest of the market was going down, but then it got hit on Friday as well. All stocks, which include US and international stocks, everything's going down, but this is heavily weighted towards US stocks, so that's why we're seeing this ratio decline. Emerging markets, they also got hit, but they were trying to establish an uptrend. The Japanese Nikkei has also been under pressure lately. Microcaps, very small stocks, they're in a downtrend now. And then we look at the S&P and home builders, pretty much neutral with this correlation between the two, not really getting any insight there. Bitcoin, it could be getting ready to go into a downtrend. It's been trailing along its 200-day moving average. And then year to date, gold is doing the best, followed by bonds. And then oil was positive until a few days ago. Now it's negative. The dollar is green, and stocks are the worst performing asset class so far year to date. And then we look at international indexes using the KST, which is a long-term oscillator. You notice at the bottom, it hasn't rolled over yet. It takes a while for this to shift. But we are in a downtrend in China, emerging markets, Europe, and Japan. We're probably going to roll over with this pretty quickly in the US as well. Then we look at correlations between the S&P and the dollar. They're having a pretty strong tendency to go in the same direction, which right now is down. S&P to oil also both going down, showing a higher correlation. The S&P to the 10-year yield also the same direction. They both have been going down. And tech to the 10-year also correlation. The tech sector and interest rates have been coming down. And then shorter term interest rates, the 2-year yield, pretty strong correlation with the S&P 500. They've also both been going down. Some long-term charts here. This is a monthly chart of the NYSE. We're falling below this 12-month moving average here. That could be negative. That's longer-term negative, and we're rolling over with the Copic curve, which is a momentum oscillator. Then a daily chart of the NYSE composite showing some weakness coming back in on a shorter-term basis. And then we look at a monthly chart of the S&P falling below this 12-month moving average. And the PPO, which is a momentum oscillator, is really starting to fall. That's showing longer-term weakness. Then we look at the S&P on top and then S&P to the CRB index on the bottom. This shows that it's rolling over, meaning the S&P is starting to underperform commodities, even though they got hit pretty hard. But this is a monthly chart. And then we look at another global ratio here, US and global stocks coming down, starting to drop below the moving average with the KST, the long-term momentum oscillator, starting to possibly drop below its moving average. Then at the end, we list those things that are positive. And even after the shellacking that the market took, it takes a while for these longer-term trends to actually change over. but we still have growth value, copper, the dollar when compared to the yen itself, and the CRB index is still in an uptrend. It got hit. Gold and silver really got hit, but it's in an uptrend. The mega caps are still in an uptrend. The FANG index, ARC, low volatility ETF, staples, the Dow Jones Composite Average, and then bonds based on price. The high yield, the total bond ETF, investment grade bonds, corporate bonds, and junk bonds, even though especially junk bonds got hit this past week. The tech sector getting really close to rolling over. In fact, it's starting to, I should have put that on the other side. It's actually starting to see a downtrend. High leverage loans took a real hit. We'll see if they're able to bounce back. The Dow still in an uptrend, but starting to get close. As the same can be said with the NYSE composite and the Wilshire, the Nasdaq and Nasdaq 100. The Nasdaq's in bear market territory, but we haven't switched to a downtrend at least yet. The mid caps, they're starting to look more negative, as are all stocks. And then emerging markets have shown some recent weakness, but they're still in an uptrend. Bitcoin could be getting ready to cross over, making a death cross into a downtrend. And then the things that are negative, even though they've been bouncing back up, the trend hasn't switched. When you look at the euro, the British pound, and compare that to the dollar, semiconductors are negative. World bond index is still negative, but trying to improve. And then small caps and micro caps, they are in downtrends, and mid caps should be added to this list as well. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.